Wagner, hello. It has been a hot summer and the equity markets are also heating up with indices at all-time highs. How do you explain this surge when the global economy is still sluggish and United States tariff policy is creating still more uncertainty in global trade?
Yeah, you could argue that there's a certain divergence between the economic reality and the rise in the stock prices. And especially since we now know that we'll get higher tariffs, at least compared to what was the case before this new administration. This will be the highest tariffs more or less since the 1930s, and clearly they will have an impact on growth, on inflation, and not in a good way. So from that point of view, you could say it's a little bit surprising that in spite of that, stock prices continue to go up. On the other hand, I suppose behind the rise in stock prices is, first of all, the results of companies over the first half of this year were in general quite good. We had the reduction in interest rates in certain countries, especially the European, the reduction in interest rates by the European Central Bank. The market is now expecting the Federal Reserve in the US to lower interest rates. So all these are factors, I suppose, that continue to support equity prices.
Public debt piles continue to grow and industrialized nations' bonds are no longer in demand. Does this create an imbalance between supply and demand for investors?
Yes, I think that's another reason why stock prices are going up. There's this distrust of a lot of investors, growing distrust at least, of a lot of investors vis-à-vis the other big asset class, which is government bonds, especially government bonds from the industrialized countries. We see high public debts, we see high budget deficits. There will be an increase in the supply of government bonds. On the other hand, when you look at equities, at least the equities of high-quality companies, these companies are buying back their own shares. So the supply of this type of equity will decrease. So you have on the one hand an asset class where the supply continuously increases. The other one, on the other hand, an asset class where the supply diminishes, and it makes sense for investors to basically invest in the one where the supply decreases, i.e. equities.
In contrast, emerging markets government bonds are significantly outperforming bonds issued by developed countries, a pattern that we have seen since the early 2000s. Are emerging market bonds an attractive investment opportunity?
I think at least they are more attractive than the government bonds of the G7 countries, in the sense that a lot of these emerging countries have shown much better fiscal discipline, monetary discipline, and so you could say to a certain degree that the industrialized countries have become the new emerging countries, and vice versa. And I suppose that the outperformance of emerging market bonds simply reflects the better discipline that these countries have shown.
The US equity market is at an all-time high. Is this good or bad?
I think the outperformance of the US equity market over the past years has been exceptional. The US equity market now represents some 70% of the world index, whereas the US economy only represents 20% of the world economy. So you could say that's a little bit a strange situation. And clearly now foreign investors are very much exposed to the US equity market. So you could say it's really over-owned to a certain degree. And it's also expensive. It's expensive compared to its own history on basically all the valuation ratios. The market is not trading at a significant premium to its historical average.
In your eyes, is this record high justified?
I think it has gone too far. You could say that especially the big US companies, the big tech companies, you could say it's justified that they trade at a higher multiple than the rest of the market. But the premium now, I think, is too high, and the rest of the US market is also trading at a premium compared to the European and Asian markets. And I think it's more difficult to justify this premium because basically the profitability is more or less similar.
Perspective's latest edition has just been published. In this paper, you took a closer look at the Japanese market and economy. Should investors consider Japan for their opportunities?
Yeah, I think the Japanese market is very attractive over the medium and long term because it benefits from one very important structural element, which is the improvement in corporate governance. You could say for a long time the treatment of shareholders was not really a priority for Japanese companies, and this has now started to change a few years ago, and the trend is really going in the direction of better treating your shareholders, improving your profitability, etc. And there's still a lot of things to do. So I think that will give the Japanese market a tailwind for the years to come.
And in general, should investors consider the Asian markets?
I think the rest of Asia is also interesting because, again, it has underperformed quite a bit over the past years. It is trading at, or these markets are trading at attractive multiples. The challenge there is to find the right type of companies, so companies which really have a high profitability, treat their shareholders well, etc. So that you have to be selective, but in general, these markets are attractive, yes.
Turning to money markets, the euro has risen by more than 12% against the US dollar. Is this good news? Does it mean that the US economy is losing its appeal?
Yeah, I think it means especially that there's a growing distrust of foreigners vis-à-vis the dollar, because the depreciation of the dollar this year is a little bit surprising in the sense that the European Central Bank has cut its interest rates a few times. The Federal Reserve didn't cut its interest rate, so the interest rate differential has improved for the dollar, and in spite of that, the dollar has depreciated. And I think it's the growing distrust of foreigners vis-à-vis the dollar, given that this new administration in the US has made it more or less clear that they want a weaker dollar.
In perspectives, you also point out that the United States net international investment position shows a large deficit. What impact could this have on investment strategies in general?
It just reinforces what I basically just said. If you have such a situation and then foreigners become increasingly skeptical about your currency, then obviously the risk of a further depreciation is quite high, especially since the dollar, despite its depreciation, is still quite overvalued.
And as is the tradition in this podcast, let's finish with a word about gold. The price of the yellow metal has soared more than 20% since January. What could slow this rise?
There's also always a possibility that after such a strong rise, and gold already went up last year, the year before, so you could always say, okay, some investors want to take some profits. There might be some news from time to time saying that, for example, the Chinese central bank has stopped buying gold, and that might then be as a trigger for such a correction. But fundamentally speaking, the general environment clearly still favors gold. And so from that point of view, I think it's a little bit dangerous to try to time the gold price, because you might be out of gold and the gold price still continues to go up, and then you never find the right time to go back into gold. So I think people should stick to their gold holdings.
Right now, would it be better to invest in gold as a commodity or in gold mining companies, which also have been performing very well recently?
I think there is room for both. One has to be aware that gold companies are more volatile. They tend to amplify the movement in the gold price. So that's very nice when the gold price goes up, but it's unfortunately it goes also sometimes the other way. But generally speaking, I think that the environment for gold companies is very good, because on the one hand you have the rise in the gold price, on the other hand you have the falling energy prices. So from that point of view, companies' profit margin, companies' free cash flows are exploding, and at least for the moment, companies are showing very much very good discipline when it comes to allocating their capital. So they're using this explosion in their free cash flows to pay down their debt, to increase their dividends, to buy back their shares. So basically, that's a very good environment.
Guy Wagner, thank you very much.
Thank you.
You will find more analysis and commentary in issue number 183 of Perspectives. Tune in again soon.